How's it going, everyone? Let's go ahead and talk about General Mills today. It is a company that is near their 52-week low. So when we look at their 52-week range, their low is $60.33, and right now they're currently trading for about $65 a share. Back in May of last year, they used to trade for about $90 a share. And when we look at their PE ratio, their trading multiple is 15.8. So we're trying to figure out, in terms of valuation, are they a good buy or is General Mills a value trap? In this video, we are going to look at the intangibles, the finances, and run some valuation models to determine if it's a delicious or a disgusting dividend stock. And this is a YouTube channel that is focused on dividend compounders. So let's go ahead and check out what their dividend looks like. Their dividend yield is 3.6%, which means they pay out $2.36 a year. The dividend payout ratio is 57%, and they're growing this payout by 4.5% year over year. So as a dividend investor, General Mills hits the mark as to what we are looking for in their dividend profile. Oh, by the way, in 2015, they paid out $1.76 a share. You fast forward throughout the years, now it's $2.36. They're much more than what you see in the cereal aisle. General Mills actually dominates the grocery store because if you look on any aisle, you will see one of their products. And historically, their main bread and butter was cereal. However, their cereal business is not thriving because, as it turns out, a lot of the boomers and older population, alongside with Gen Z and the new kids, they do not like cereal because they understand how unhealthy it can be. But the funny thing is, milk and cereal is still very popular and resonates with the millennials, which I am one. So in light of that, General Mills is making a fast pivot to be the go-to brand for pet foods and treats. Essentially, General Mills is in the business of producing foods that people and pets eat. Their iconic brands include Blue Buffalo, Bugles, Cheerios, Chex Mix, Cocoa Puffs, Cinnamon Toast Crunch, Haagen-Dazs ice cream, Pillsbury, and Yoplait. If you lived through the 90s, then you understand how much brand recognition their portfolio has, which includes over 100 different products and brands. I took a look at their balance sheet and things are looking a little slow. The company is in a period of flat growth, but their balance sheet is very solid and they are laser focused on returning gains for the shareholders, which as a dividend investor is important. However, I would rather see them growing again at a mid to high single digit number. Regardless, they're paying a healthy dividend that's sustainable and they're buying back shares in the meantime. And now it's General Mills. $10,000 turns into $18,000 in 10 years. Their CAGR, 6.2%. Their best year, they went up by 43% prior to the pandemic. Their worst year, they went down by negative 31%. Next, let's go ahead and look at their shares outstanding over the years. So back in 2010, it does look like there were about 689 million shares of General Mills on the stock market. However, throughout the years, they have been buying it back, but during the pandemic, they were diluting the shareholders for a little bit, and now they're laser focused on buying back those shares. So currently, there's about 583 million shares outstanding. That sounds a lot better than freaking almost 700 million shares. And remember, buying back shares is a good thing because if there's less shares outstanding, that means each share that you own as a shareholder has quality over quantity. Next, let's go ahead and look at some numbers. The first one that we're going to take into consideration is their revenue, the top line. When we look at 2015, they posted $17.6 billion. That is absolutely bonkers. You fast forward to the next year, it went down by negative 6% at $16.5 billion. And then the following year, they went down again. However, since then, they have been on a positive trend of increasing their top line, which is exactly what you want to see as an investor. And in 2023, General Mills posted $20 billion of revenue. This is amazing. This is fantastic. And when we look at their net income, which is the bottom line, it's sort of the same story. However, one major call out is last year, their net income decreased by negative 4%. While we're looking at their numbers and finances, let's go ahead and look at their free cash flow. So back in 2015, they posted $1.8 billion of free cash flow. This is a cash flow heavy business. And as you fast forward throughout the years, it's been up and down. However, However, at least the free cash flow has been on a consistent trend. The best case scenario, what you want to see out of a business is for them to be growing their free cash flow year over year. The next best thing is for the free cash flow to at least be steady. And it does appear so at about $2 billion, except for 2020 when they posted $3.2 billion. That we can just write off as an outlier. So their free cash flow checks out and things look okay. I would say their finances and numbers, not the worst in the world. It's looking pretty good. Next, let's go ahead and take a look at their technical indicators to see what their stock price movement has to say about General Mills. It looks like the market sentiment for General Mills is pretty healthy, and I'm saying that based on their trading pattern and their RSI. Their trading RSI for the past few months is roughly at about 50, which is what you want to see. So it's not being oversold, nor is it being hyped up like a meme stock. They do seem to have a line of support at around the $62 to $63 range. And now we're at my most favorite part of the video. We are going to run some valuation models to figure out the intrinsic value of what General Mills should be worth.
Well, intrinsic value, in other words, the only reason for making an investment and laying out money now is to get more money later on, right? That's what investing is all about.
And then we're going to compare that to what the Wall Street analysts believe General Mills is worth. The first one is going to be the multiples valuation. Essentially, we're going to be looking at the PE ratio for their industry peers. So we're looking at like PepsiCo, Treehouse Foods, UNFI, Kellogg's, and Post Holdings. When we take these companies into consideration, the median PE ratio is 24.1. Plugging that into the formula alongside with their earnings per share of $4.11, this spits out a multiples valuation price for General Mills, $99.02. Moving right along to the discounted cash flow analysis model, we're going to figure out an intrinsic value based on their free cash flow. And as we learned earlier, it's all over the place. Their average growth rate for the past 6 years is sitting at 1.62%. However, we're going to go ahead and plug in a value of 7% based on the Wall Street analysts following this company. Taking this number into consideration with some balance sheet numbers, this gives us a DCF price for General Mills, $61.85 a share. Moving right along to the dividend discount model. Essentially, we're going to figure out an intrinsic value based on the dividend growth rate. When we look at their dividend payout for the past 5 years, that dividend growth rate year over year is sitting at 4.8%. Instead, we're going to shave off that 0.81% and just plug in 4% into the equation. That is going to give us a DDM price for General Mills, $61.36. And remember, General Mills is currently trading for about $65 a share, so it's not outrageous. And the last one is going to be the Benny Graham's valuation model, and that is going to give us an intrinsic value price of $54.29, which brings us to the conclusion. What is the intrinsic value for General Mills? Well, based on our 4 valuation models, their intrinsic value is $69.13. However, let's go ahead and see what Wall Street has to say. So Wall Street believes that General Mills should be worth about $72.78 a share. Their low estimation is $58, and some analysts believe that General Mills should be worth $96 a share. So we said $69, Wall Street says $72. I think a $3 discrepancy is not the worst thing in the world. So after hearing everything, you're kind of interested in General Mills. So let's try to figure out an acceptable buy price with a margin of safety baked in.
And you don't need a huge margin of safety. You should have something that you always should feel you're getting a little more than what it's worth. And there are times when we've been able to buy wonderful businesses at a quarter of what they're worth.
So General Mills is currently trading for about $65 a share. With a 10% margin of safety baked in, then your acceptable buy price becomes $62 a share. Is $62 outrageous? No, because their 52-week low was $60 a share, so it's absolutely possible. However, if you want a 20% margin of safety baked in, then your acceptable buy price becomes $55 a share. The last time General Mills traded for $55 a share was February of 2021, so roughly 3 years ago. So what you see on your screen right now is the balance sheet for General Mills, and you're wondering, what is my opinion? Well, after looking at their numbers and considering their potential future, I think General Mills is priced fairly right now at $65 a share and a PE ratio of 15.8. I do not think they are undervalued, nor are they overvalued. But when cereal costs $5 a box in 2024, consumers are not going to be happy, nor will they buy it like they did in the past. It's a box of sugar. Let's be real with one another. In no universe should 2 boxes of cereal be around $10 to $12 with tax. So sure, General Mills might sell some cereal for a little profit because they're increasing the prices and artificially inflating the revenue and boast about it. But a majority of the consumers will be boycotting cereal for the time being, which will hurt their top line. I'm telling you right now, I know inflation is ridiculous, but if they were to lower the price of their cereal, I feel like more consumers would buy it, which would increase their revenue from a volume perspective. However, they're taking the different approach of selling less cereal at a higher price, which boggles my mind. Maybe that's my hot take. I think the future for General Mills will be pivoting into savory snacks and focusing and prioritizing their Blue Buffalo pet food business segments. I think based on everything, I cannot label them as a delicious dividend stock. On Scout's honor, I just can't. I think General Mills is the definition of an average company. They're not good, nor are they bad. So for a 3.5% dividend yield, that's what I see them as. A good 3.5% dividend yield. I don't see growth and I don't see doom and gloom. So let me know what you think about General Mills. And please, for the love of your stepdad's boyfriend, please do your own due diligence and research. And with that said, I will talk to you next time. Dividend Compounders with Cheese, signing out. Stay safe, everyone.